welcome to the Monday Futures Market Outlook for July 9th, 2012. This is Patrick Serezna. For those of you that have not had the opportunity to try out the eminisource.com trading room, complimentary memberships are available on the website. As always, we start off with the chart of the US dollar index futures, and while we were observing the bullish breakout out of this wedging formation, that red reversal candle made us take a little bit more of a short-term neutral stance, and probably we were a little too early in doing so. Our bigger picture stance of bullish US dollar continues to be the predominant trend, and so our short-term stance on the US dollar remains bullish. Primarily, we can see on a lot of currencies the rollovers that are occurring that continue to support this. All of our technical measured moves imply that this rally could easily still tack on another $1 to $2 on the upside before we start hitting some overhead resistance levels. There is a couple of much bigger picture scenarios that even allow the US dollar to go through a massive squeeze higher that could even see 87 to 89 on the upside, but that is not a high probable scenario. It's just one of the scenarios. This upside target of around the midpoint of around 85 is a reasonable upside target for a systematic move higher, and only under a massive squeeze, which would have to have an outright collapse of the euro occurring at the time, would allow the US dollar to have a substantially stronger rally. Next year, I want to take a look at the euro, and when we take a look at the euro, you can see where the U.S. dollar strength is coming from. We had that flagging formation that is now completely rolled over, and the euro is toying right at that 122, 123 focal point, right along the lows where it put in. And so this was our original downside targets, and we're now retesting it. There's always the possibility of a double bottom here, but we don't trust that thesis at all. In fact, our bigger picture forecast for the euro has always been to head down to the 118 to 120 area down below, and even one of our bigger picture scenarios was looking for 115 on the downside. Really at this stage, while we still have not technically broken this 122, 123 level, we certainly are not in any way trying to be interested in trying to call a market bottom on this euro. The risk that the euro sells through this point and continues to distribute is a very probable event, and so we continue to have a distinct bias for the euro to go lower. Next year, I want to take a look at the 30-year Treasury bonds, and we are getting a bullish breakout attempt, and I want to say attempt because we've had about 3 of these occur in the last month, and each time it led to a little bit of distribution, but at this time with the jobs numbers in rear view mirror and then a couple other little events like that, you're going to see this time it may actually stick. So we'll see what happens. We remain bigger picture bullish, the 30-year Treasury bond, in spite of all of the concerns of how low those interest rates are and so on. The fact is that money is flowing into the strong US dollar and subsequently parking itself in the places that have been doing the best, which in this case the 30-year Treasury bond has been a very good performer. At this juncture, if this bullish breakout does occur, we could first see the retest of the 152, 153 level, but there is a measured move target that approaches the 158, 160 zone if this really is a big move that is going to be occurring in the next over the next 2 months. So we're not necessarily assuring that there is a massive breakout about to occur, but we certainly would not be shocked if we saw it. So let's see if for starters whether this week brings about some follow through on the upside, and if it does, then we'll start measuring out where the upside targets would be. Next year, I want to take a look at copper futures, and copper had a very bullish 3-day sequence the other week, but has now started to give some of it back. While copper is trying to find its legs here, really in the bigger picture, so long as the U.S. dollar remains relatively strong and the global economy looks to be continuing to weaken towards borderline recessionary type environments, this is an environment where copper tends to be relatively weak, so we do not trust these rallies. Even if copper does come back for one more little spike higher towards 360, we are fully expecting the price of copper to fail off these levels and not only trade back down to the 320, 325 level where its lows were, but we still have bigger picture targets for this year on copper below $3. So let's watch to see where it tapers off, and then we'll go from short-term neutral to short-term bearish to go with our long-term bearish outlook. Next year, I want to take a look at crude oil. And crude oil is going through a much-needed bounce. After dropping almost $30 on the downside, it was extremely oversold, and some consolidation was in order. Really, at this stage, just like copper, it came with a little bit of a bounce and gave a little bit back. We still are going to remain short-term neutral on this as crude oil will continue to consolidate. We could see temporary spikes even to back to 88 to even $92 on the upside. But once this consolidation ends, we expect crude oil at minimum to go back to retest that 75-77 level for a double bottom. And while that is one of the scenarios, there also is another scenario that could see crude oil trading below $70 on the downside before it really bangs out the lows for the year. So while we did see some aggressive selling and we are seeing bouncing, we do believe that this summer will bring about still some further consolidation and bottoming formations in crude oil that could still see even lower lows. Next year, I want to take a look at gold futures, and gold had again, similar to all other commodities, had a nice rally the other week and then reversed in the last 3 day trading sessions. Really, at this stage, we were looking for even 1650 on the upside, even as high as 1670 for the top end of the bounce before it reversed. But we clearly have to admit that there is a chance that gold has begun that reversal already. Really, at this stage, we do believe that this is a sideways consolidation point, and that there is still room for gold to make a break while all commodities are weak. That could see gold even go down to 1440 to 1460 on the downside. We even have a bigger target that could even go below 1400, even down towards 1300 on the downside, but that's a pretty bold thing at this point. Let's just see whether or not we get a break and a test of 1440 before we start over evaluating some bigger picture things. Nonetheless, we do expect gold can still stay weak during this cycle. At some point again later this year, gold will be a buying opportunity, but it is likely to be a buying opportunity off lower levels. So we're going to first watch how this consolidation continues, where those levels come in, and then we'll make the market calls from there. That brings us to wanting to look at the S&P 500. As always, we start off with a weekly chart with an 80-week moving average that depicts the bull and bear market cycles the market has gone through over the last 3 decades. In the last few years, we've gone through a number of false start signals up and down, including a retest of it just in the month of May here. And really at this stage, we remain relatively above the bullish 80-week moving average. But at this stage, if we go through another substantial wave of selling here at some point on the market, we may see us temporarily break below there on a weekly closing basis, which would give another sell signal. While that would give a sell signal on the weeklies, we're not 100% convinced that this necessarily has to lead to the next major bear market, but it certainly would indicate the level where the market is quite oversold on an extreme basis. So we'll see where any new waves of selling lead to and whether or not it leads to a cross of this sell point. So when we take a look at that S&P 500 on the daily charts, we had this rising wedge, which we more or less we've been observing. We've felt that the S&P could go for a key top retest up around this 1380 level on the upside. And while we have now it just came a hairline to it before reversing, really at this stage we do believe that the risk-reward proposition of being long the S&P 500 has a diminished value at this stage. stage, it is likely that the summer will still bring about another round of selling in the S&P. Again, it doesn't necessarily have to be an overly bearish scenario where we crash, but another full leg lower similar to the one in May would not be out of line. Under that scenario, we could probably see 1240, even 1220 on the downside of the S&P before we start looking for bottoming formations in the S&P on the downside. So we're distinctly bearish this market, thinking that that the highs will come in here because we haven't got a sell signal yet. We're going to remain relatively neutral over the next few days, but we do believe that somewhere up here is where the highs of the market will be banged out. So just to again review that intermarket observation, we are now short-term and long-term bullish the U.S. dollar, and while we are long-term bearish commodities, we still have yet to see them actually roll over and really start selling in a bearish way. In the same regard with bonds, we are seeing that bullish breakout. We're going to be bold enough to go short-term bullish here, but if this breakout that occurred over the last 2 days doesn't stick, we'll go back to short-term neutral until we see that and a rally actually follow through. Same with stocks. While we are not long-term bearish stocks, we simply are looking for those stocks to be short-term bearish. Once we get a little bit of further follow through on the selling, we are going to go short-term bearish stocks for the next cycle lower, and that accounts the same for global stocks. But most global markets are actually in a full bear market, hence our longer term bearish stance on global stocks, and we will obviously be turning short term bearish probably about the same time as the U.S. stocks will turn short-term bearish for some broader selling. We believe that even though longer term we have that stance, that's a stance that we've had for pretty much the year. At some point, maybe even within the third quarter, if we see some very dramatic selling that finishes moves, those longer term stances may actually change. But at least at this juncture of the market, we believe that this stance still stands pretty good. That was your Monday Futures Market Outlook. Thank you for joining me.